Good morning, everyone, and thank you for joining us today. My name is Leonard Lucas III, and I'm the Chief Investment Officer of Stratosphere Capital Partners. And it's my pleasure to welcome you to this month's investors call. Today, we'll be focusing on the state of crypto and walking through what is taking place in the market over the past week and how it positions us moving forward. We've seen a dynamic environment, Bitcoin and Ethereum giving back some gains after their strong summer rallies, more than 800 million in outflows from institutional crypto products, and US macroeconomic data continuing to stir sentiment across digital assets. At the same time, selective inflows into Solana and XRP show us that capital is still seeking growth opportunities, even as the broader market recalibrates. In today's discussions, we're going to cover three key areas: the macro backdrop and how US economic data and Fed policy are shaping risk sentiment in crypto, market flows and positioning, what institutional investors are doing with Bitcoin, Ethereum, and key altcoins, and the outlook. And this is the scenarios we will see playing out as we enter the final quarter of 2025 and how we're positioning to both protect capital and capture opportunities. Our goal here at Stratosphere Capital Partners, as always, is to give you clarity, confidence, and insight into how Stratosphere Capital is navigating these shifts and where we see the potential for long-term value creation. So let's begin. I want to first start and discuss with you a little bit about this market, which is caught between growth and gravity. The crypto market is once again at a crossroads. And after months of relentless gains that carried Bitcoin above 120,000 and Ethereum past 4,000 per token, the tone of late September has shifted sharply. What we're starting to see in the crypto markets is as fund flows have turned negative, volatility is back with a vengeance, and institutional investors are increasingly looking at US macroeconomic data rather than token fundamentals when making their decisions. The past 2 weeks alone, more than $800 million has exited digital asset investment products. Yet beneath the nervous surface, there remains a growing sense that crypto is no longer a passive experiment, but as we've been telling you for the last 2 years, it remains a powerful asset class, tethered tightly to global economic cycles, central bank policy, and institutional behavior. The question not is whether the market can absorb near-term turbulence and set up for another parabolic surge, or whether headwinds will force or deeper correction. So these are the hard numbers. Bitcoin right now is hovering right above $113,800 at this time, which we've seen a tremendous fallback from August highs near 124,000. The intraday range in late September has stretched between 109,800 and 114,200, which shows that wide swings is signaling trader uncertainty. Ethereum trades near about 4,170, holding the psychological importance of the 4,000 line, but showing choppy price action. As we started to collect more data, we're starting to see that we told you that digital asset funds now saw 812 million in net outflows last week. Bitcoin products accounted for 719 million of those outflows, where Ethereum products lost about 409 million of outflows. By contrast, some altcoins attracted capital. And one of our favorite tokens, Solana, logged in 291 million in net inflows, and XRP bought in 93 million in net inflows. This selective behavior shows us that capital is not abandoning the sector wholesale, and this is a positive sign for you as an investor. So the capital is not abandoning the sector, but it's repositioning away from the largest tokens towards higher growth narratives. And in the crypto world, we call it altcoin season. So we truly believe that in the next couple of months, that's going to be tremendous positioning into altcoins and investment opportunity in altcoins. And we teach you and talk to you more about the key sectors that we're looking at here at Stratosphere Capital Partners. A question that everybody asks, the trigger of why the sudden reversal. We were going up high, everything looked good. But now while we're having this volatility, in the crypto markets? The answer lies not on chain, but majority of the factors is in Washington, D.C. and in Wall Street. The latest round of U.S. macroeconomic data surprised to the upside, but we started to see Q2 gross domestic product was revised upward, and it's basically signaled stronger growth than initially expected. We also seen through our data durable goods and orders came in firm, suggesting that the industrial economy has not slowed as much as feared, and that's great. When the industrial economy is doing well, then we start to see that people begin to produce more goods, and that's great because when there's a lot of goods available, people have the ability to buy those goods. So in traditional markets, strong data is usually good news, but in the world of crypto, which thrives on liquidity and risk appetite, those robust numbers have an unintended consequence. They reduce the urgency of the Fed to ease policy. That in turn basically dampers expectations for abundant liquidity. And truly, liquidity is the lifeblood of speculative assets. When this happens, you start to see that institutions will begin to trim exposure, and it will lead to steep outflows like we've seen in recent weeks because of all this macroeconomic data. And when institutions doesn't have a sure sign, that's when institutions get iffy. So institutional investors we're seeing are not abandoning digital assets altogether. We told you that instead they're redistributing bets. Bitcoin and Ethereum, which are the top dogs of crypto, are being treated cautiously. Their share size make them the easiest assets to trim when reducing risk. Solana and XRP, by contrast, continue to attract inflows supported by narratives around scalability, how big these companies could be, payment adoption. We've seen so many different payment adoption systems with Solana and product upgrades. We're starting to see tremendous upgrades to Solana's network and also to XRP network. This rotation reflects a market still hungry for growth, but unwilling to carry excess risk and the most liquid names. So the reason why you're starting to see, Bitcoin has already been up 30 something to 40%. So that access risk, most investors have made pretty good on Bitcoin over the year, and they don't know if they want to take that excess risk when there's macro uncertainty that's rising in the capital markets. So the on-chain metrics paint a complex picture. So there's an article from Glassnode that reported that 95% of Bitcoin supply remains in profit, which is tremendous for the average investor who's invested in Bitcoin. Pretty much majority of people who've invested in Bitcoin this year are in profit. That means there's ample incentive for long-term holders to sell if nerves increase. And we're starting to see that as well. Just because in this year, if you're turning a profit, most people want to be able to keep that profit and they don't know what's going to happen in a couple of months ahead. Future markets have seen short squeezes and long liquidations, and this is a sign that traders are leaning heavily on leverage and being punished for it. And they have been punished for it over the last couple of weeks. And so we still will begin to see that over the next couple of weeks that a lot of these future markets are going to be squeezing a lot of guys out who have these long positions, and they're going to be getting liquidated. So for professional investors, these metrics highlight a market where technical levels and derivative dynamics may matter as much as fundamentals in driving near price swings. I want to talk a little bit about the role of ETFs and institutional demand. And really much of this year's rally was fueled by the arrival of spot Bitcoin and Ethereum ETFs, which pulled in a bunch of capital, tens of billions of dollars in cumulative inflows. And these vehicles opened the gates for pension endowments, wealth managers to allocate without touching exchanges or wallets directly. But ETFs are proven to be a double-edged sword. Just as they amplified, inflows early in the year, they now accelerate outflows. And this mechanism has tied crypto markets more tightly than ever to institutional sentiment. So a lot of these big institutions are now pumping a bunch of capital, taking a lot of capital out, and they do this in cycles. So you have to very much watch these guys because as they're putting in capital into these assets and taking out capital in these assets, they control the market. And basically, very much in this time in crypto, what these guys do in this institution and this institutional investment is going to be tethered to the Federal Reserve and its interest rate trajectory. So you want to make sure that you're watching that. Last thing, there are some regulatory crosswinds, and so no crypto outlook is complete without addressing regulation. And the U.S. is currently debating stablecoin legislation, including the Genius Act, which can set new standards for reserves, orders, and issuance. Depending on its final form, regulation can either provide clarity that accelerates adoption or introduce frictions that slow the market. So as investors, you should watch closely as stable coins remain the backbone for DeFi and definitely the backbone for crypto trading. So you should definitely be watching the regulations on new legislation that's coming in from the federal government. What is the long-term out case? And this is I'm going to use this as a case for optimism. Despite there's some near-term caution, the structural drivers for crypto remains intact. So the first thing is we have institutional adoption. It's not reversing. ETFs and custody solutions are here to stay. Blockchain technology continues to progress. There has been tremendous improvements in scaling. There's been tremendous improvements in the networks and security and interoperability, cross-chain interoperability, and also demographics favor crypto adoption. Younger investors consistently begin to allocate to digital assets at higher rates than their predecessors. And then not only that, we have to talk about global diversification. We begin to see tremendous inflows, especially in countries like Switzerland, Canada, and Germany, highlight that crypto is not purely just a US phenomenon. And I believe that these long-term factors will provide a sturdy foundation, even in the short-term outlook is choppy with crypto. So this is my state of crypto outlook for this year. We're going to give you more information coming in the next weeks. And we thank all of you for joining on this call today. You have a great day.